Hello, and welcome to our webinar, 4 must-know questions to ask about executive compensation plans. This is a hot topic for many credit union directors and CEOs for a lot of very good reasons. It can help credit unions attract and retain their top talent, but there are also some risks if the plans are not set up correctly. To help guide you through the key questions to ask and get the answers you need, we're very fortunate to have with us John Moreno from the CUNA Mutual Group. More about John in just a moment. But first, I want to tell you about the National Directors and CEOs Leadership Convention. In celebration of our 40th anniversary, we're delivering more practical guidance and solutions for credit unions at with our 40 for 40 series, with webinars just like this one. And of course, we have even more expert speakers and guidance at our 40th Directors and CEOs Leadership Convention in Las Vegas, beginning August 1st. John Moreno is one of our featured speakers at the convention, and we're very glad to have him share his advice with us today in this special webinar. John is an executive benefits specialist for CUNA Mutual Group, a company that specializes in supplemental executive benefit programs specifically tailored to credit unions. John brings his broad knowledge of credit unions, their regulatory, accounting, and investment environment, and current developments in executive compensation to help credit unions make the most of their benefit dollar. So without further ado, I'll turn it over to you, John.
Thanks, Dennis. Much appreciated. I figured we would start with an overview of what we're going to cover for the next 25 to 28 minutes of this webinar. First, we'll start with a little bit of background around non-qualified deferred compensation plans. These are always a hot topic. There's a lot of information. There's also a lot of conjecture and what we'd consider misinformation out there in the marketplace. So I want to set some stage around the background and those plans, how they're used, and what they look like. Second, the key question you should ask as a board member or leader of the credit union is, what could go wrong? A friend of mine's quote is, what could possibly go wrong? But again, what could go wrong? What could happen that would adversely affect the executive, the credit union? What is the chance of those things happening, and how do you address that? Next, how does a plan compare? Right now, the hot trend, if you would, tends to be centered around split dollar arrangements. Really elegant plan design can work very well. However, being able to demonstrate comparison of different plan options and understand what the trade-offs you're entering into are and how those affect the institution is key. Next, could I repeat the plan again? This is a key question that you should ask. Interestingly, most states haven't really dove into this piece as heavily. The state of Michigan actually has, and their question is, could you do the same plan for next generation of management leadership that you would like to attract and retain? And then finally, can I stand a higher level of regulatory scrutiny? Key question to be able to answer. A lot of credit unions enter into these plans. There's a lot of information being provided from either one side or a single source. You want to make sure that if someone outside of the organization's leadership were to come in and ask some very difficult, detailed questions, you'd be able to answer those, and you'd be able to stand up, or your plan would be able to stand up to that type of test. Now, some common challenges we hear about in the marketplace, and this is the first and foremost, is that non-qualified deferred comp plans are not a core board competency. The board's tasked with setting the strategic direction of the credit union, governance of the overall organization, and effectively looking out for the interests of the member shareholders of the organization. Most of the time, boards are not steeped in the arcane world of non-qualified deferred compensation plans, and therefore it's generally not something that boards find themselves able to address effectively. Second, the regulatory environment is constantly changing, either at the state level or the federal level. And an example would be 457F, which is a form of deferred compensation plan. Final regulations were proposed last year. They're still in a comment period. We look for final regulations to be issued sometime this year. So always in this world, or in this marketplace, there is something changing from the regulatory environment. And then finally, boards lack the necessary time and expertise to be able to really dive into being able to do this process in an effective manner and in a fiduciary sound manner as a first person. And so they often rely on outside resources, be it staff members of the credit union, be it outside advisors, accountants, attorneys, and providers. And so those are the common challenges that we see in the marketplace. Just to give an example on some regulatory considerations, we had the NCUA letter on the call report, which updated some reporting around these types of assets and investments that surround deferred compensation plans. We've seen collateralized assignment split dollar policies getting additional attention. Seems anything that adversely affects a credit union or a group of credit unions tends to get regulators looking into that type of arrangement and what could have been done from an oversight standpoint to make things better. Michigan had Bulletin 2013-18 CU, which really was specific to deferred comp in general, but then much more specific in terms of split dollar and the requirements around that type of arrangement. NQA guidelines on impermissible investments and the use of impermissible investments. And again, we see coming down the road potentially additional guidance from the NCUA on the use of those assets. And then FASB accounting changes. Last year, in beginning of 2016, we had the ASU, or Accounting Standards Update 2016-1, which affected loan loss reserve calculations, which I think was the focus most in the credit union space had with respect to that update, but also embedded in that same update was a to accounting standards for various types of investments. So really staying abreast of different areas is very difficult, if not impossible, for a board to manage on their own. And so let's dive into a little bit of more detail around non-qualified deferred comp plans and what they are and how they act. So on the next slide, we've got basically how do SERPs operate, and these are often called SERPs, which was traditionally Supplemental Employee Retirement Plan, which they were really operated around a retirement construct. Updated, they're called non-qualified plans, non-qualified deferred compensation plans, deferred comp plans, carve-out plans. They've got a number of different names. But how do these operate? Well, first and foremost, almost 60% of credit unions that are larger than $100 million in assets or greater offer SERPs to their employees, so offer some form of non-qualified deferred compensation plan to their employees. What a SERP or a non-qualified plan is a written promise by the credit union to pay a benefit at some point in the future. It's going to pay out at a different date, and it's going to have different vesting rules depending on what type of plan it is, and we'll go into that in more detail in a moment. IRS rules or the risk of forfeiture keep the SERP untaxed until the point at which the benefit either vests or the non-forfeiture risk lapses, or the executive separates from service and begins drawing against the plan, depending upon the plan structure. And when we look at the details around the different types of plans and how they're being used by credit unions, around 75% of credit unions in the marketplace offer a 457B plan. We'll talk a little bit more about what a 457B plan is in a successive slide. 55% of credit unions offer a 457F plan to their employees, either senior manager, CEO, or senior managers. And we'll talk more about definitions around that as well. And then finally, 30% of credit unions offer both types of plans to their senior leadership. Some definitional information. So the 457B plan is a plan where the employee can effectively defer up to an additional $18,000 in the current year of income into an account that is theirs upon separation from employment with the credit union. So it's effectively used as a supplement to a 401k plan for those employees who are either being tested out of full commitment or full ability to contribute to their 401k plan, or employees who are having who are maxing out the existing contribution limit and really want to try and put more away towards their retirement income. Income taxes are not paid on those until distribution occurs. And then, of course, it does have to be reported on the Form 990 report. That plan design often looks very similar to a 401k lineup in terms of fund options that are available. There is some customization flexibility available around the plan design, but it is a very, very useful and widely used plan. Something to be aware of if you're in the current mode and you go out and Google everything, which is excellent. I do appreciate an informed group. Make sure that when you Google any kind of guidance or guidelines around 457B, that you are specific to 457Bs for not-for-profit entities. There are plans that are known as governmental 457B plans that have different requirements, guidelines, vesting rules, and catch-up provisions from 457B as it applies to not-for-profits, by extension credit unions. So be careful if you do Google that term that you're specific enough that you get the information that's valid to you. Second, we have 457F. So the easy way to remember a 457F is that plan is effectively an IOU from the credit union to the employee. So they're going to pay a certain sum of money to the employee at a specific date in the future. The employees in that plan have to be from a select group of management, so it can't necessarily be applied across the entire enterprise. There are no contribution or benefit limits other than safety and soundness considerations of the sponsoring credit union. Taxes are owed in the year that the risk of forfeiture lapses. That's also known as vesting in more common language within credit unions. But basically, when the benefit vests, taxes are owed on the value of that benefit that vests in that year. So it's usually exceedingly tax heavy. Form 990 generally rules require that that for state chartered credit unions, you report each year the amount accrued for the plan, and then you actually have to re-report everything that's paid out when it is paid out. So it's got an interesting treatment within the Form 990 structure for state chartered credit unions. Finally, we've got life insurance-based programs. It's an alternative to the 457F structure. There are no program limits on the life insurance-based program, again, other than that safety and soundness consideration. Generally, the executive applies for a permanent form of life insurance under that type of plan. The credit union is paying the premium for the policy, and depending on the structure, that could be treated as bonus compensation to the executive, or it could be treated as a loan that actually gets repaid from the plan. That last version, which is known as loan split dollar or loan regime split dollar, is the one that you hear about in the industry today as you hear about the split dollar concept. On the uses, again, 457B is used to supplement the 401k when the executive has already maxed the 401k capacity that they've got as a personal individual. It's appropriate for the executive at any life stage. So even your younger employees, if they're in management, they're part of that select group, but they're younger, they're just maxing out that 401k, it can be appropriate for them. And it's generally used to supplement or help with retirement payout. 457F, normally payouts are set at specific intervals in time that coordinate with the executive's life event, either retirement, college funding, etc. So those can be dovetailed to align with the executive's life cycle so that they have more meaning and context for that executive. Those can be used for retention or retirement needs, so you can use them to retain existing employees to specific points in the future, or help existing employees move into that next phase of life, of retirement if it's appropriate. And more they're being used as part of a recruitment package. We're seeing in offer letters to new CEOs or in negotiations for CEOs that hire on to organizations, the use or the reference to a market competitive deferred compensation plan being embedded in that employment agreement, where in the past that was something that was decided upon after they've been on board for some time and possibly seasoned within the role at the credit union. Life insurance base generally tends to have its sweet spot, if you would, with executives that are between 10 and 15 years until retirement. Oftentimes we will find that those can be used in even shorter instances depending upon what's trying to be accomplished. They are most commonly paid out in alignment with the retirement time frame. Those plans are used for retirement of the executive as well as recruitment on the front end if you're bringing in a new CEO or chief executive. The next slide, we talk about some considerations that you should make or that you should keep in mind when you're working through these types of plans. And these are at a high level and will be available on the National Leaders Directors Conference website following the presentation. But basically, 457B has simpler administration requirements. It's immediately vested. It allows for a deferred compensation kind of bonus structure to be implemented. From the executive standpoint, the B plan vests immediately. Funds contributed to that are vested. A risk that the executive needs to be aware of is that those assets are subject to general creditor provisions until they are distributed from the plan. 457F plans, vesting and payment are defined often by age, years of service, death, disability, or termination. They can be very flexible in terms of structure. They can also be a defined contribution, meaning the credit union sets aside a certain amount of money that the benefit will be generated from, or defined benefit where the credit union specifies a given benefit target that will be paid out to the executive. From the executive standpoint, those are generally not contributory by the executive. The executive is not deferring their own money into that type of plan. They can be flexibly structured to accommodate the life cycle and needs of the executive. Downsides, they're subject to full taxation as income at vesting. So if the executive's in one of their prime earning years and getting this additional sum of money, their tax bill could be quite high in that year. And the benefit is subject to the claims of general creditors of the credit union until distributed. So if the credit union were to fall on hard times, be put into a position of liquidation, basically the executive has to get in line with the other general creditors to get their benefit. Life insurance-based plans, the credit union can be paid back for funds advanced to fund that plan on the executive's death, so it effectively retains capital for the credit union. They can be structured with a relatively low cost to the credit union in terms of the carrying cost of the structure. And they generally have a little bit more predictable yields on behalf of the credit union compared to other types of plan options. On the executive side, benefits that are drawn from a life insurance-based plan are generally income tax-free as they're used in retirement. The employee must be insurable. So if an employee has significant health issues that would preclude them from being insurable, generally speaking, that's going to prevent them from being able to use that alternative. The benefit, the death benefit is income tax-free to the employee's beneficiaries. So it can provide a very, very nice estate planning enhancement to the employee or estate enhancement to the employee. In the next section, we're going to touch on some of the funding options that can be used in these plans. And you've probably heard of some of these. You may not have heard of some of these, so we'll touch on those. In the first bucket, we've got annuities. Now, in the early to mid-'80s, annuities were the only real investment option that was used in these types of plans. And that began to convert over, calling around 2001, 2002, we started seeing general investments being used, basically mutual funds or mutual fund-like vehicles that were structured to help either offset the cost of these plans or enhance the benefit of the plan for the executive. More recently, we've seen business or bank-owned life insurance used in these plan structures. And that's basically a policy that is specifically designed for ownership by the credit union and use by the credit union or a corporate entity, or a combination of various options. We've seen plans that have a combination of investments in annuities, annuities in business owned or bank-owned life insurance, or credit union-owned life insurance, investments in BOLI as well. So there are different options. And then, of course, as we mentioned, the insurance-based solutions, the split dollar options, all use an insurance product just by definition within that plan design. Now we come to the due diligence piece. And due diligence becomes much, much more important as regulators start to apply a higher degree of scrutiny to these plans. On this page, we've got a table that we've used in engagements, and this effectively is a comparison of plan options or alternatives that the credit union may consider as they're looking at various different options. So up in the top, we have the description of the plan. So in the first case, you have a 457F plan. There's no funding offset. So in this instance, the credit union is saying, we're going to pay a benefit to you, the executive, in a year out in the future, or in multiple years out in the future. And we are simply just going to expense the cost of that plan. We're going to just absorb that into our compensation expense. And so there's the different characteristics you should consider as you're looking at these different options. What's the current amount of money, the capital commitment needed to make that plan alternative work within a reasonable degree of certainty. Is there additional capital required if we're adding on a plan? We've had plans where credit unions have come in to review the existing plan and wanted to add to it. What is the total funding commitment under the plan? What is 25% of credit union capital? So there's a little bit of confusion or concern about this limit, if you would, or this amount of capital, the 25% of capital. In the banking world, 25% of capital is a hard ceiling for a bank when they're using impermissible assets or assets like these for deferred compensation and other purposes. And so that is from guidelines that were promulgated by the Office of the Comptroller of the Currency. In credit unions, that rule at the federal level does not apply. However, there has been discussion and reference internally with regulators about some form of limit or consideration. So what we ask credit unions to do normally is just consider that as one of the things that they're evaluating in terms of a guideline for prudence, understanding that that's not necessarily a hard and fast limit, but it is something that you should keep an eye on as you're weighing the prudent cost of a plan for the credit union. 2016 credit union annual earnings. And that's, I think we skipped ahead one. The credit union annual earnings from 2016 basically helps compare the plan relative to earnings that the credit union is generating. Then we've got income statement impact, including adjusting entries, opportunity cost, average annualized income statement of the plan, funds returned to the credit union, et cetera. So really comparing the different ways to effectively accomplish the plan objective, BOLI, investment-based solutions, split dollar, no funding at all, and the different components that apply to the credit union so that the board can effectively weigh the cost and opportunity cost of those different options and make an eyes wide open determination. Next, go to the next page. We've got a decision tree for consideration that takes your different options. So you're assuming that you're going to do a plan of some sort that pays a benefit to the executive in the future. And this is not just 401k overflow. This is trying to retain the executive into the future. So there your options likely would fall under potentially split dollar and 457F. Now under each of those options, there's a number of ways to structure a plan. The split dollar has a loan component. Is it a demand loan, hybrid loan, term loan? Those all have different definitions that are beyond the scope of today's webinar. 457F, is it a hybrid plan, defined benefit plan, defined contribution plan? And then underlying that on the split dollar plan, you always have an insurance policy associated. Is it a whole life policy, index universal life policy? How do those compare to one another? And then on the 457F side, you've got the BOLI, bank-owned or credit union-owned life insurance approach, annuity approach, investment-based or managed account approach as well. So making sure that you're addressing each of these levels and having an eyes wide open discussion about the options that are available, as well as making sure that you are tracking your results of your conversation as it pertains to that type of option within the plan. On the next page, we have a chart which answers the next question. Could I repeat the plan again as prudent in the future? We've had credit unions that have put a plan together that really committed a substantial chunk of credit union capital. When I say we've seen, we haven't done this, our internal structure wouldn't allow for it, but we've seen credit unions where there's an inordinate amount of commitment to one plan for the current CEO. And the plan by design has, just for whatever reason, has a very long period that it will be enforced. And so could the plan be repeated for a successor CEO if that's necessary in order to evaluate the prudence of the plan? So to make sure that what you're doing today does not preclude you from being able to do the same thing again for a successive CEO. So otherwise you're tying a future board's hands in terms of being able to offer a competitive compensation and benefits package. We want to make sure that that gets done. Due diligence, again, analyze the program or make sure you have a record of review of the program for legal authority. Do you have the authority to do this in the jurisdiction that you operate, federally chartered, state chartered, et cetera? What are the accounting considerations that are taken into account, and have those been validated by your third-party accountants? The vendor's accountants might be a great resource to use, but you really want to make sure that you test any of the accounting assumptions presented with your own external auditors to make sure that they're in agreement with those treatments. Risk management. How is this going to be risk managed within the construct of the credit union? Are you going to rely on employees within the credit union to help with part of that process? Is it going to be third-party risk management? How does that overlap with your normal operating process? You want to evaluate alternatives to the program and/or investments. Kind of showed a high level of that with the chart in the decision tree a little earlier. Want to keep that on track. Regulatory reporting items, what needs to be reported from a Form 990, federal standpoint, et cetera. And then take all the steps that you would normally take regarding an ongoing third-party relationship, making sure that you're doing your vendor due diligence as part of your ongoing process, et cetera. The next page, really OTC guidelines, keeping an eye on those, given they don't apply to credit unions directly, but they're often referenced by either the states and not yet the federal, but we've seen it with the states. Keep an eye and an ear towards NCUA discussions and activity, also state discussions and activity about how these plans are treated and how they're reviewed on an ongoing basis. Analyzing the risks associated with the program. Again, these are the standard risks. You should be evaluating anything that the credit union does as expressed by the NCUA Examiner's Guide. And these are key to transaction risk, compliance with applicable regulations, emergent regulations, credit risk, if there's a risk to the credit union of default from any of the pieces of the plan, what are you doing to mitigate that or understand that? What is the interest rate risk over the life of the plan to the credit union? Liquidity, both now and in the future. If there's additional funding required for the plan, how does that affect you? Strategic risk, does this preclude you from making certain decisions in the future? How does it do that? And then reputation risk, what would happen if something adversely affected the credit union and the plan came to light to the general public? What would be the fallout, if any, and how would you address that? That was a very quick run through in terms of those key questions you should ask yourself about a non-qualified deferred compensation plan. I hope we provided a high-level overview of a framework you could use, or at least a path for evaluation of those types of plans if you're considering putting one in place or entertaining one, as well as kind of a decision tree if you're going down the path of those different boxes you should check in terms of getting to that final determination. So Dennis, I want to thank you and then Directors and CEOs Leadership Convention for allowing me to address the group today. And with that, I'm going to turn it back over to you.
Thank you, John. Yes, there's a lot of information packed into just 30 minutes. Appreciate you taking the time to do that. And folks, I sincerely hope now you have some of the key answers you need when addressing executive compensation plans, and in particular, non-qualified deferred compensation plans. John will be talking more about this topic at the National Directors and CEOs Leadership Convention at Caesars Palace in Las Vegas. And I encourage you to come out, talk with John. This is a great opportunity to talk with him one-on-one about maybe some of the questions, concerns you may have at your particular credit union and in your particular situation. So I encourage you to come out, talk to John, get even more guidance that you need, and I want to thank everybody for taking the time today. Some folks who have joined late, we're going to be sending out a replay, or if you want to share this with other members of your board, your senior staff, feel free. We are going to be sending that out so that you have it. Have a great day, folks. And John, thank you again.
Thanks.